A dividend stock is not about excitement. It is about cash flow. And misunderstanding that difference is one of the most common mistakes investors make. So let's slow this down and look at what a dividend stock really is, how returns actually show up, and what risks are often ignored. A dividend stock is a share in a company that often returns parts of its profits to shareholders. Instead of reinvesting all their earnings back into expansion, the company distributes that cash, or some of that cash rather, directly to the owners. And this cash payment is called a dividend. And so, when you own a dividend stock, you are not relying only on the price going up, you are also receiving money while you hold the stock. This immediately changes the nature of your investment. Companies usually pay dividends for one simple reason. They no longer need all their cash to grow. A dividend-paying company is often a mature business operating in a stable industry with predictable revenues. It doesn't need to reinvest aggressively in order to survive. Instead, they return the excess cash back to shareholders. Bear in mind, this is not generosity, it is simple capital discipline. If we accept that the only reason to invest in a company is to generate returns, then those returns have to come from somewhere. In most cases, they come from business expansions, higher revenues, higher profits, and growth over time. But not all businesses can grow forever. Some companies reach a point where expansion slows down, not because they are failing, but because they are already mature. And when that happens, growth is no longer the main attraction. So these companies return cash instead. This is where the dividends come in. They are not a bonus. They are a way to make a mature business investable when growth is limited. Think about industries like tobacco, telecom, automotive manufacturing. These are all stable businesses. People keep smoking, people keep using mobile data, people keep buying cars. The stability is valuable in its own right, but there are natural limits. The USA has roughly 300 million people. A telecom company cannot suddenly sell 50 million new mobile plans out of nowhere. And an automotive company like Ford cannot realistically double the number of cars it sells in a year. The market is already largely saturated. So, instead of chasing unrealistic growth, these companies generate cash and return part of it to shareholders. And the dividends are the mechanism that turns stability into returns. Dividend stocks generate returns in three main ways. First, through dividend payments, obviously, which is the real cash paid to you, quarterly usually. Second, through modest price appreciation, because these companies can still grow, just not explosively. And third, through reinvestment. If the dividends are reinvested, compounding can quietly become very powerful over long periods of time. Dividend investing is therefore not fast, but it is persistent. Imagine you have $500,000 invested in a dividend stock that pays 4%. That investment generates around $20,000 in cash per year, paid to you regardless of short-term market movements. The company itself may grow slowly, so the share price might appreciate modestly over time, but the key point is that the business is already large and stable. If you reinvest those dividends, you gradually increase the number of shares that you own, which then produce even more income in the future. By contrast, investing the same amount in a broad equity ETF might deliver an average return closer to 10% over long periods, which would be around $50,000 per year on paper, so quite a bit more. But that return is not stable and can vary widely from year to year. This is where risk and real-life circumstances matter. Someone who is older and needs reliable income may prefer the predictability of dividends, while somebody that is younger may accept volatility in exchange for higher expected growth. Dividend stocks feel safe, but they are not risk-free. Dividends can be reduced or eliminated. High dividend yields can signal financial stress. Rising interest rates can make dividends less attractive. Slow growth can turn into stagnation. And the dividend is not a bond. It is not a promise. It is a decision that management can change. Understanding that really matters. In conclusion, dividend stocks trade growth for income. They reward patience. They reward discipline. They also reward time. But they still require understanding. Income without awareness can be just as dangerous as speculation. That is what a dividend stock really is.